All right. It's Casual Friday again.
Yes, it is.
It doesn't feel like it's been a week. It's been a fast week, at least for me. How are things with you, Steve?
It's been a fast week too. I'm still working remote, and I'm up in North Tahoe, and we've got every bit of 3 or 4 inches of new snow in the last day or two.
So it's been 2 weeks since you and I did this.
Yeah.
And since we did the Casual Friday broadcast, and the last time we talked, it was earthquakes.
Yeah.
Today it is snow. I don't know what's next. 2 weeks from now, maybe.
Locust.
Yeah.
I don't know.
Famine. Pestilence. Let's hope not. But kind of cool that you got snow. You know, nothing you can probably ski, right?
No, it in fact, it snowed about 1.5 inches in the morning, and then it melted, and then another 1.5 inches or 2 in the afternoon, and that's pretty much gone.
That's cool.
It's been off and on today, but no, it's gone.
Nice. Well, It's May, so we still have spring weather, right? It was, down here it was like 90 degrees and then 70 degrees, and so
yeah, let's hope spring is longer than a week this year.
I know, right?
Mm-hmm.
Well, cool. Well, we have a lot to cover today. Market, it's 1:00 Pacific time, so markets just closed. I would say today they were mixed, right? The Dow was up a little bit today. NASDAQ and S&P was kind of flat or down. Just looking over the last 5 days, it feels like we say this every week. It was a wild week, right?
It was a wild week, and one of the things I want to talk about is one of the reasons why it was a wild week. And by wild, we mean some pretty good moves. We had 3 or 4 days in a row of negative returns in the markets, and then the last couple of days, I think we finished more up than down. But a lot of what's on people's mind is the I word, and that's inflation.
Right.
And if you could bring up the first slide, perhaps. Yeah. This was a slide from just 2 years ago, and it was, on the cover of Bloomberg Business Week, is inflation dead? And if we can move to the next slide.
Yeah, let me.
A lot has happened in the last 2 years. And we've gone from the cover of the magazine saying, is inflation dead? Low rates forever, to this week, we had the infamous I word on the cover of Barron's. So now inflation is back, according to the financial press.
Right. And this kind of whipsaw leads to, markets were lower to start the week. Really tried, but then tanked on Tuesday, got decimated on Wednesday. But between Thursday and Friday, the NASDAQ actually finished positive on the week. And the Russell 2000 was down 0.08%. So not too bad, but I guess inflation-led volatility, is that what you would call it?
Yeah, and maybe we can even go on quickly to the next slide.
Sure.
Inflation was kind of the word of the week, and part of the reason why inflation, well, first of all, what's inflation? And I'll never forget in college, walking into my favorite economics class, the teacher had a cartoon up there with a Lucy or something from the Peanuts, Charlie Brown, and it was, inflation is too much money chasing too few goods.
Right.
And so I remember seeing that every day for however many economic classes I was fortunate enough to take with Dr. Lee.
Sure.
So too much money chasing too few goods. And so what we saw on this chart, this is just showing the change over a year ago of retail sales. And you can see over on the far right-hand chart, what an anomaly. People were talking about, well, two sides of that. One was during the closing of the pandemic, we saw retail sales fall off the cliff. You can see how far below that flat line we were.
Yeah.
Which, you'd have to go back to the great financial crisis, 08, 09, and it even went lower than that, albeit quicker or not for as long.
Yeah.
And now we have pent up demand. And you can see, boy, us consumers, we like to consume. And this chart shows that we've been roaring back to life as we exit the pandemic, whatever that looks like.
Yeah. I mean, this is not an inflation chart per se. This is retail sales.
Retail sales, and I thought this was interesting because it's one of the, what goes into inflation. Well, too much money chasing too few goods.
Right.
So this is an example of that, where everybody's been pent up. There's pent up demand. I think there's pent up savings, pent up money, pent up needs to replace things that folks, I guess, just that you couldn't get from Amazon, delivered to your front door.
Right.
Folks are going out and shopping, and I think this is a signal of that. And if we go back to that's demand chasing too few goods.
Yeah.
And then we talk about too much money chasing too few goods. Well, during the pandemic, one of the things that the government did was throw a lot of money at the problem. I've seen numbers 7, 8, 9, $10 trillion.
Well, more per capita, more per American adjusted for inflation than the New Deal.
Which is so historically,
Yeah, this is the biggest. This is the most. This is the biggest.
So this pressure of too much money, quote unquote, too much money.
Right.
Remember a year ago, we were worried if it was enough. So now how times change. But now folks in the market are starting to worry about the rise of inflation, and the $68 million question is this transitory, or is inflation here to stay? In other words, is this the effect of a short-term bottleneck where people are just, pent up demand, and it's going to be relatively quick and be gone? Or has inflation reared its head and is going to stay for a while?
Yeah, I mean, that's the $1 million question. That's it, right?
And
is the Fed right, or are they wrong?
Correct. And so we even had sometimes it's the fear of fear itself that causes problems in the investment world. And I think we've started to see that a little bit this week, as is, these signs of inflation. Is it here for longer, or is it going to be short term and transitory? Right. And I think it concerned the Fed enough that they even released their April meeting minute notes, the minutes from their last meeting in April. Yeah. And the chairman actually talked a bit about tapering, and that's where it's one of the forms or the ways that they can combat inflation is not to get too complicated or in the weeds, but the Fed has been in there buying bonds and assets to pump. When they buy a bond, they give people money for the bond that they're buying, and that is a way for them to infuse money or cash into the system. Right. Tapering just means that they're not going to quit buying those bonds, but they might slow down the pace. They're going to taper their amount of buying.
Right. And they're even going to talk it down before they actually do it, right? They're going to start for talk rates down maybe a little bit.
Trying to calm the market down, saying, hey, we're aware of this. One of the first things you might do is to start tapering our bond buying if needed. They didn't say they are. They just said that they're aware of it and they might. And if we can go to the next chart, unless you have some comments on this further.
Yeah, well, no, I mean, I think we're presuming the Fed is saying this is transitory, which is just another way of saying temporary. And the question is whether the Fed is right. And we're part of this experiment to find out, is the Fed right or is the Fed wrong? Is this transitory or temporary, or is it not? And if it's not, they're going to be forced to raise interest rates. And raising rates tends to cool off an economy. I mean, under normal conditions, inflation is the smoke that comes off of a hot economic fire. Mm-hmm. But we're in a place where we have an economic fire, but most of the smoke is being generated by all of this money pumping. And so if the Fed is wrong, what they're left to do is raise rates. And then now we're in a rising interest rate environment, which can be challenging. And we certainly, I mean, I don't want to go doomsday here, but you have slow growth and rising interest rates. Slow growth and rising inflation, rather. That's stagflation. And that's a pretty ugly investing environment. I'm not going right there, but I mean, that's what we're trying. that's the long game of what we're trying to avoid here.
Yeah, we're a long way away from, hopefully, from stagflation. To remind everybody in the audience that stagflation was what it was like in the 70s. Super high rates, high inflation, high unemployment. Not a good scenario.
Yeah, no growth. But I mean, if you're growing a lot and inflation, that's one thing, right? Because you have
I'm sorry, low growth to no growth, or negative growth.
Right.
So yeah, one of the tools besides tapering, tapering is like tapping on the brakes, and hitting the brake or hitting the emergency brake. Well, that's rising interest rates. So the Fed wanted to hint this week to the markets that, hey, we're aware of inflation. We're willing to do. They didn't mention raising interest rates yet, but the market is trying to predict are they gonna have to raise interest rates sooner? I think they're on the record of saying that they were going to try to keep interest rates pegged at 0 until 2023.
Right.
And so the market is saying, can they wait? And again, why do we care as investors? And that's what this chart is designed to show.
This one's from Columbia Threadneedle here.
From Columbia Threadneedle, one of our investment partners. And on the left-hand axis, it's the PE ratio. And then on the horizontal axis is bond yields. Mm-hmm. And there's this inverse relationship. In other words, the lower the interest rate, so if you go out all the way to the extreme on the right with interest rates pegged at 0, people are willing to pay more. So price divided by earnings, are willing to pay a higher price for companies that can grow their earnings.
Right.
So when interest rates are low, that's part of the reason, perhaps, why we've seen the market recover so well, is that it's allowed PE expansion. It allows prices to go up. What people are able to buy businesses for.
Let's do a quick primer on PE. A PE ratio is the price to earnings ratio. And so the price of a stock is related to the earnings of a company. And there's a multiple. So if it's a 15 multiple, if a company made $1, then their stock price would be $15, let's say, right? And so people are willing to pay a higher multiple or more money per share or more money related to earnings if there's no other place to go, like if there are no bonds. It's the old TINA trade. There's no alternative. And so as there becomes this alternative where interest rates move higher, you can go somewhere else and get a better rate, maybe at less risk. And so people are willing to pay less of a multiple, which means if the S&P is going to go up, these companies need to make more money. They can't just rely on, or investors can't just rely on people paying a higher multiple or paying more for the same earnings. This is an interesting chart, though. I like this one a lot because we are right now somewhere just north of 1.5%, which is right. We're between 1.5% and 2% bond yields, which puts us, if I can put my little cursor, we're right about here, which is about right because the PE of the S&P 500 is somewhere in the mid-20s. Which historically is pretty high, right? Average PE for the S&P 500 is 15 or 16%, which would put us somewhere closer to about right here, which would be interest rates at about 3.5%. This suggests that if rates go up, stock prices are coming down, right?
Yeah, and being higher up on the a higher multiple, given it's not a problem till it becomes a problem.
Yeah.
Just because we're at a high multiple. Well, we should be there based on where interest rates are. And that goes back to why is everybody concerned about inflation? Because if rates do rise, we're going to move down and to the left on multiple. It's called multiple contraction. And so that's what we're looking at.
Yeah, to distill the idea into a sentence, if interest rates go up, stocks are probably going to come down, right? Because they're trading at a high multiple, they'll be trading at a lower multiple. But seeing this and the negative or the correlation between the S&P PE ratio and the bond yield is fantastic. I love this chart. You picked a great one.
Yeah, it just really stood out to me. But again, I love this kind of stuff. But it's just why is everybody afraid of the I word, the inflation word? and it's rising interest rates cause, all things being equal, cause what somebody's willing to pay for businesses' earnings to come down.
Yeah. Well,
And so,
this kind of gets back to the all eyes on the Fed. Is this transitory or not? Is this temporary or not? Because if it's temporary inflation, the Fed doesn't have to do anything and interest rates won't go up.
No, it doesn't. Just because we're a little higher value, if rates don't move, we can afford to be higher value. It makes sense. But if rates have to move up, if the Fed is forced to raise interest rates and tap on that brake pedal, then we could see the market, pull back.
Yeah. And I mean, you've been at this long enough. We've seen Treasury yields north of 3%. I mean, even then, that's pretty low. And so the fact that rates would be higher isn't the problem. It's the moving. It's the move from one place to another that's hard. I just moved houses. I can tell you, moving is hard, right? Moving from one place to the other is a real pain. Once you arrive there, everything's going to be okay. But moving from like absurdly low, historically low rates on treasuries to something that's still low but not absurdly low, that shift from one place to the other is going to be. I mean, it could create some volatility, right? That's what we're getting right now.
It's like the earthquakes we talked about 2 weeks ago that I had been going through up here in Northern California. It's the move during the quake that is scary.
Yeah.
Once it stops, it's not so bad. You can do it.
Once it stops shaking, you're all right.
Yeah.
That's a good analogy. But that's what we're talking about here. It's the move that can be painful.
And sometimes it's the anticipation. People are trying to anticipate the anticipators. So none of this has happened yet, but people are worried about it given what we talked about.
Well, I mean, a good example.
Yeah,
a good example is, we have record earnings, but why isn't the market surging? Well, this got priced in November and December. We had the best 8 weeks that we've had in a very long time, and it's because investors were forward looking to this spring and summer and the rebound that we were going to have. This actually, I'm gonna jump over to my chart if it's okay, Steve.
Mm-hmm. Perfect timing.
Because I think it's a good time where we say investors are forward looking, and we can get into this. As we all look forward and we all try and read the tea leaves, we get into this dangerous predicament of trying to time the markets, when to get in, when to get out. Oh, interest rates are inflation's moving higher, therefore interest rates are moving higher. I'm going to get out until things are better, right? And then you wind up shooting yourself in the foot. I've got this chart. This is from Russell Investments, the Russell 2000 Index. You've probably heard of that. I know you've heard of it, Steve, but people who are watching may have heard of that. This is the impact of the last 10 years, ending the end of 2020, the investment impact of missing the best market days. And so if you were invested with an initial $100,000 investment, if you were invested all of the days for 10 years, your $100,000 would be $366,000. And you can see the red part is the growth. But if you, in those 10 years, you missed the best 10 days, you would be up to only $210,000. The 10 days over a
decade.
That's crazy. And so you can't tell me, I don't care who you are, your predictive powers, any investor's predictive powers aren't so good that the 10 days to not be in and the 10 days to be in. That's crazy. If you miss the 20 best days, which is averaging out of 2 days a year, but if they're the best ones, now you're down to $141,000. And if you miss the best 40 days, just cutting to the end, over a decade, you would have actually lost money, because those 40 days over 10 years were the days that you gained. Specifically, you would have been up $366,000, almost $367,000. So, when things get choppy, I know I get a lot more phone calls on this, and Steve, you might also, where people say, I'm going to get out until the coast is clear. But like you can see just from this week, Wednesday was awful. Thursday was fantastic. If Wednesday was awful and that was your tipping point where you capitulated and say, I I just can't do it anymore. You would have lost all Wednesday and not made any of it back on Thursday. So, we are not traders here. We are investors. And the part of being investor is choosing some good investments and riding those things for a very long time. And so I love to dispel the notion that you can time your way into better returns because you just can't.
It was mentioned on this broadcast last week from Don from our office, and old cliches become cliches because they're
true.
And it's time in the market, not timing the market.
Right.
And this chart just illustrates it better than anything I've ever seen.
Yeah, I think I mentioned this chart. This is why I dug it out. I think I mentioned this chart when we were having that discussion. And these are the impacts of missing just a few days. 10 days over 10 years. The impact is $165,000. That's crazy. That's crazy.
And now you don't forget, if you threw in, if you had a brokerage account where you had trading costs, you have perhaps tax ramifications.
Oh, this doesn't take taxes into account. Yeah, you can have gains if you're having along the way. Yeah, absolutely.
And so trying to factor all that in, good luck. It's impossible.
It just makes it even worse still, doesn't it?
Even if I knew exactly what was going to happen, which I do not, I'd probably mess up and still miss 10 days, even knowing if I knew the outcome. I still probably wrote it down wrong.
Yeah, well, I have a friend of mine trades cryptocurrency, which trades 24/7, and he intended to get out on like Saturday last week. Now, this is not a cryptocurrency podcast. We get all sorts of trouble with compliance, but he intended to get out Saturday, and he was at his daughter's birthday party, yada, 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 forgot to get out. Market tanked on Sunday, but then jumped back on, it's like there's no way of knowing. And it's something as simple as your kid's birthday could cause you to miss one of those best 10 days or miss something, right? It's
your wife was down that day,
Yeah, right. You just can't be that precise. Right. So, this chart is pretty clear and pretty dramatic in its explanation of things. The other chart is the one I always reference for as long as I've been a financial advisor. When things get choppy, everybody is always, when things are going well, they say, "Oh, I'm going to wait for a pullback and invest more." Sometimes, or maybe they're going all in because things are going up. I know we saw that speaking of crypto stuff. But when the going gets rough, people don't always have the guts to get in. This is the cycle of investor emotions chart, and there's 100 versions of this chart. If you just Google cycle of investor emotions or market emotions, you can find a bunch of these on Google. This one is also from Russell Investments, but it shows this cycle where it starts with optimism and goes to excitement and thrilling, and then markets kind of peak on this euphoric craziness, and that's where you find, if people are talking about NFTs or cryptocurrencies and you think this is insanity, this has got to be the top. And the reason people say it's maybe the top is because it's all this euphoria, all this, like you were saying, a lot of money and nowhere to put it. So you kind of keep getting on these speculative investments. That's euphoria. And then when you get a pullback, and 2 weeks ago when we were looking at these charts, Steve, one of your charts showed that pullback, that mid-year pullback, an average pullback of at least 15% every single year. Mm-hmm. Those pullbacks and those when we hit corrections, that can create anxiety. And then, of course, if it cascades down, you get fear, panic, despondency. I've also seen the despondency on the is capitulation, where even the most steadfast may lose their nerve and go out. But of course, that it's when you're the most fearful is when you should be investing, and not when you're the most euphoric. Where do you think we are on the chart right now? I'm gonna ambush you with this question.
Well, I've given up trying to guess where we are on the chart, but let me just say we're closer to the upper left, I think, than we are the bottom.
Yeah.
Right. Things seem pretty good. My spider sense is tingling.
Yeah,
I'm reluctant to go all in, as they say.
Yeah.
So, I'm not trying to estimate where we are, but it sure seems closer to euphoria than despondency.
Yeah, and it's interesting. I don't know. I love this chart because people see it and they say, "Oh yes, oh yes." But also, you can get a correction in markets and have some anxiety and a little bit of fear, but not actually have it move to despondency because you're in a retirement account, you're 40, and you can't take it out anyway without getting clobbered by taxes. So, it doesn't. You don't always ride the wave all the way down. Even if you're a long-term investor, you look at the market go down for a couple of weeks in a row and you say, "Oh, I don't love this."
It's important to note too, though, that's natural. This is a natural thing.
Right.
We're wired as human beings. It's like, I don't like pain, run. So as investors, though, we almost have to be a fireman who drives by a house that's on fire. My first instinct is I'm running out of there.
Yeah.
The fireman's wired differently. He wants to get in the house as soon as he can to rescue people. Yeah. And as investors, we have to think like firemen and say, okay, when things are good, perhaps you're a little more aware of what you're doing, maybe a little more cautious. And when things are really, really bad and my stomach's upset and I can't sleep at night, that's the time to be a little more aggressive. Perhaps.
Yeah, it could be. And you've got to fight that natural instinct to flee. And no, let your thinking brain overtake your lizard brain part of your noggin and say, okay, I'm not taking this money out in 6 months from now. So,
And at Ford Financial Group, we tend to try to have these conversations, obviously, over time. But certainly, when we open a new account or begin a new relationship, and we have this conversation, especially seems to be more when things are down, because that's fear hurts worse than elation. It feels good.
Yeah, twice.
And so, it's natural to go through these emotions, but we want to try to do the time to do your homework is prior to committing capital.
Yeah, you sandbag your house before it rains. Yeah, you sandbag, you put down sandbags before it rains. We try, I always say the best time to figure out your risk tolerance is not when things are going well, but when things are going bad, right?
Correct.
Because that's when you're stress testing your ability to hang in there. And so, when things are going great, everybody's fearless. It's when things are bad that you find out how you're actually doing. So,
and then maybe if we can bring this full circle too, it's like, remember I opened with the 2 slides of the magazine covers.
Yeah.
And typically you see a lot, I used to call it the Oprah Winfrey effect, where by the time no offense to my lovely wife, I always use her as these examples and it's terrible. But it's like when she heard it on Oprah Winfrey and she asked me about it when I came home that afternoon, I knew we were either at the top or the bottom, depending on it's similar to those magazine covers when they're putting bulls on the pictures of bulls, which means strong market, on the cover of your financial press, and then they have these, when the things are at the bottom, they have these bears, it's terrible. And by the time it hit Oprah, it's probably at one extreme or the other.
I remember, it was either late 08 or early 09 that Susie Orman was on Oprah and told everybody to go to cash. And it was like, it's like the worst financial advice I've ever seen on television. Yeah. And it just about marked the bottom, so.
Maybe it was more like go to cash and buy my book.
Yeah, right. Yeah. Well, unfortunately, fear sells, and that's an easy way to get roped into this. And I've said it. I think I said it in our monthly video that we posted on Facebook, which is, when the local news comes to interview us, they're not here because it's good news. They only show up when it's bad news, but it's good news more often than bad. It's like you hear when planes crash, but you never hear. It doesn't make the news when the plane lands successfully, like it does over and over at every airport every single day. So. You try not to get caught up in the emotions of all of this and try not to get bogged down in the swings day by day and, check your portfolio, be concerned, but don't panic when things are getting sideways. So,
absolutely.
Well, I think we've been going for about a half hour, Steve. So I think we'll leave it there. If you're watching this and you want to comment below, go ahead and post your comments, and we'll try and get to them when we can. Better still would be to email your advisor here at Ford Financial Group, or email us at the general inbox at info@fordfg.com, or you can find us on the web at fordfg.com. So, Steve, have a
Brian,
great
my biggest takeaway from this personally is that, man, I need the pandemic to get over with because I need a haircut.
There you go. We're getting there. We've got it. People are getting their shots. We're getting out there. Retail sales.
Not so much up here, back here.
Yeah. Well, your business up front, party in the back today. So that's good for a casual Friday. Perfect. All right, Steve, have a great weekend. We'll do this again.
You too, Brian.
Bye.
Bye-bye.